As investors everywhere lose money to the financial crisis, many are wondering whether large, catastrophic market swings, known as black swans, could ever be predicted with any degree of accuracy. IESE professor Javier Estrada considers the impact of outliers in emerging markets, and he finds that they can have a massive impact on the long-term performance of investors' portfolios.
It's mostly a matter of size, and that means that fluctuations, we have fluctuations every day. Sometimes the fluctuations are small, sometimes the fluctuations are large, and sometimes the fluctuations are very large. Most of the time, what we call black swans, which we should call outliers in finance, are basically these very large fluctuations. These are basically the black swans. We can try to put a formal definition, like so many standard deviations away from the mean, or a given percentage of a daily fluctuation, but most of the time we refer to black swans mostly to these unpredictable, very large swings in the markets. They have a huge impact on long-term returns, and this is something that people find hard to understand. Not only they have a very, very large impact and very substantial on their portfolios, but also this impact, it tends to be larger in emerging markets than in developed markets. Just to give you an idea from the two of the things that I worked on in the last few months, if you looked at the largest 15 developed markets, and you looked at them over a very long period of time, actually 10 days happens to be roughly on average about 0.1 of 1%. That is 0.1% or 1/10 of 1% of the typical sample size in these developed markets that I looked at. And actually, if you compare the buy and hold strategy with having missed the very best 10 days and the very worst 10 days, what you find is that missing the best 10 days would have reduced the final terminal wealth to about 51% compared to a buy and hold strategy. On the other hand, if you actually had managed to avoid the worst 10 days, then your terminal wealth would have gone up 150% compared to the buy and hold strategy. So 10 days, which is 0.1% of the total days that I looked at in the sample, actually have this gigantic impact on terminal wealth. If you look at it from the point of view of emerging markets, the impact is actually even larger. And that means that if you had missed over the 16 emerging markets that I looked at over a very long period of time, 10 days is about 0.15% of the total number of days that I considered in the average emerging market. If you had missed the best 10 days, your terminal wealth compared to a buy and hold strategy would have been minus 70%, and if you had avoided the worst 10 days, your terminal wealth would have gone up over 300% compared to the buy and hold strategy. This is very hard for investors to actually figure out, but it's absolutely critical. The impact of these black swans is staggering on the final value of their portfolios. Much more often than people tend to think. We tend to use in finance a lot of the normal distribution, and we use it because it's convenient, not because it is a good description of the data that we find in reality. Particularly if we look at daily data, what we find is that outliers, black swans, are much more often happen much more often in reality than the normal distribution would actually indicate. And what I've been looking at of the markets that I've been looking at, we find them more often on a factor for 5 to 6. That is, we tend to find black swans or very large deviations 5 to 6 more times often than what the normal distribution would actually indicate. I wouldn't say that it's impossible. I would say that it's virtually impossible, and certainly, the best thing that an individual investor could assume is that he has no ability to predict them consistently over time. And we can just look at what happened over the last several months. Last year, during the year 2008, the S&P 500 in the U.S. fell about 35%, which was kind of unpredictable. When we were preparing for a rebound of the market between the beginning of this year and the first week week of March, the market actually fell down another 25%, and when we were getting ready for another big depression, actually the market rebounded by about 45%, which happened between the first week of March and now. And this is basically impossible to predict. So one of the best things that investors could do is actually assume that they have no ability to make these predictions. I should mention that we do have a program at IESE. It's a 2-day program that this year we run on November 18 and November 19th of 2009, in which we spend basically 2 days thinking about how an individual investor should manage his or her portfolio. But let me advance you 2 ideas from that program. One is that the best thing an individual could do is to assume that he has no ability to consistently predict the market. And this basically means that he needs to get used to the idea that if he wants more return, he needs to be exposed to more risk, and if he's exposed to more risk, then he needs a longer investment horizon. If you have a short investment horizon, try to protect your money. If you have a longer investment horizon, then you can take more risk, then you can expect a higher return. Recommendation number 2, focus on something that most people do not do, and that is how you properly allocate the assets of your portfolio. What is the proportion of each asset in your portfolio, and focusing on rebalancing that optimal or reasonable portfolio over time.